Before we dive in, please remember that this video is for educational purposes only and is not financial advice. I am not a financial advisor, a lender, or a real estate professional. The world of mortgages is incredibly complex and deeply personal. You should always consult with a qualified, licensed professional before making any decisions about your own financial situation. All numbers and examples used in this presentation are for illustrative purposes. You get that mortgage statement in the mail? Or maybe it's an email notification that pops up on your phone. You open it and you see that number, the big one, the total amount you still owe. But then your eyes drift to another number, the interest rate. Maybe you locked it in a few years ago when you thought it was a great deal. Or maybe you bought your house when the market was frantic, and you had to take whatever rate you could get. And every single month, a little voice in the back of your head asks the same question. Am I overpaying? Am I stuck with this deal for the next 28 years? Could I be saving hundreds, maybe even thousands of dollars every single year? That nagging feeling is the reason why Americans refinanced over $2 trillion in home loans in a single recent year. $2 trillion. That's a number so big it's hard to even comprehend. It's a signal that millions of homeowners, just like you, are looking for a better deal. They're looking for a way to unlock the financial power sitting dormant inside the four walls of their home. But here's the scary part. A huge number of them make critical mistakes in the process. They get lured in by flashy ads, they don't understand the math, or they choose the wrong type of loan, costing them a fortune in the long run. This video is going to change that for you. My promise is simple. Over the next several minutes, I am going to completely demystify the world of mortgage refinancing. We are going to strip away all the confusing jargon and the complicated financial language. I will show you, in plain English, exactly what refinancing is, how it works, and most importantly, how to determine if it's the right move for you. We're going to turn that feeling of uncertainty into a feeling of confidence. You will leave here with a powerful understanding of one of the most significant financial tools available to a homeowner. So, what is mortgage refinancing? Let's make this incredibly simple. At its core, refinancing is just the process of replacing your existing home loan with a new one. That's it. You're essentially paying off your old mortgage by taking out a new mortgage, ideally one with better features and terms that benefit you. Think of it like trading in your old car loan. Maybe you got your first car loan from the dealership at a high interest rate. A year later, your credit score has improved, and your local credit union is offering much better rates. You wouldn't keep paying the dealership's high rate, would you? Of course not. You'd go to the credit union, get a new cheaper loan, use that money to pay off the dealership, and then enjoy your new lower monthly payments. Mortgage refinancing is the exact same concept, just on a much bigger scale. You're swapping out your old, expensive mortgage for a new, better one. Now, people do this for three primary reasons. And I want you to listen closely because one of these is likely the reason you clicked on this video. The first and most common reason is to get a lower interest rate to reduce their monthly payment. We call this a rate and term refinance. The second reason is to change the length or the term of the loan, for example, switching from a 30-year mortgage to a 15-year mortgage to pay the house off faster. The third, and this is where things get really interesting, is to pull cash out of the home's equity to pay for things like home renovations, college tuition, or consolidating high-interest debt. That's called a cash-out refinance. For right now, let's focus on that first one, the one that gets all the headlines, the rate and term refinance. This is the classic move. The goal here is singular. Save money every single month. Let's run through a real-world example. Let's say 3 years ago, you bought a house and took out a $400,000 mortgage for 30 years at a fixed interest rate of 6.5%. Your monthly principal and interest payment on that loan would be about $2,528. You've been paying it dutifully every month, but lately you've noticed that interest rates have started to come down. You do some research and find out that with your excellent credit score, you could now qualify for a new 30-year fixed-rate mortgage at 5.5%. 1 percentage point lower. It might not sound like a lot, but let's do the math. If you refinance that same $400,000 balance at the new 5.5% rate, your new monthly principal and interest payment would be about $2,271. That's a savings of $257 every single month. Every single month. That's over $3,000 a year, $3,084 to be exact. That stays in your pocket instead of going to the bank. Think about what you could do with an extra $3,000 a year. That's a family vacation. That's a huge boost to your retirement savings. It's peace of mind. And over the life of the loan, That 1 percentage point difference could save you tens of thousands of dollars in interest. This is the raw power of a rate and term refinance. It's a direct attack on the total cost of your home. But wait, can't be that easy, can it? There has to be a catch. And there is. It's called closing costs. Refinancing isn't free. Just like when you got your original mortgage, there are fees involved. You'll have to pay for things like an appraisal to confirm your home's value, title insurance, and lender origination fees. These costs typically run between 2% and 5% of the total loan amount. So, on our $400,000 loan, you might expect to pay somewhere between $8,000 and $20,000 in closing costs. This is the moment where most people get scared and give up. They see that big upfront cost and think it's not worth it. But this is where you are going to be smarter. You're going to learn about the single most important calculation in refinancing, the break-even point. The break-even point is the precise amount of time it takes for your monthly savings to completely pay back your closing costs. It's the magic number that tells you if the refinance is actually a good deal. Let's go back to our example. Your monthly savings are $257. Let's say your total closing costs for the new loan are $8,000. To find your break-even point, you just divide the total closing costs by your monthly savings. So, $8,000 divided by $257 equals about 31. This means it will take you 31 months or a little over 2.5 years to break even. After that 31st month, every single dollar you save is pure profit straight into your bank account. So the critical question you have to ask yourself is this: do I plan on staying in this house for longer than my break-even point? If you know you're going to be transferred for work in 2 years, then a refinance with a 31-month break-even point is a terrible idea. You'd move before you ever recouped your costs. But if you see this as your long-term home, your forever home, and you plan on being there for another 5, 10, or 20 years, then that refinance is an absolute financial grand slam. You would be throwing money away every single month by not doing it. Understanding this one simple calculation, the break-even point, is what separates savvy homeowners from everyone else. It empowers you to ignore the hype and make a decision based on pure, simple math that benefits your family. It's about knowing your timeline and making the numbers work for you, not for the bank. But lowering your payment is only one piece of the puzzle. What if your goal isn't just a smaller monthly bill? What if you need money? I'm talking about a significant amount of cash to finally build that new kitchen, pay off those sky-high credit card bills that are eating you alive, or help your kids with college. What if you could turn your house into your own personal bank? That's not just a fantasy. It's the reality of the second, and arguably most powerful type of refinance. And that's exactly what we're going to break down next. This powerful tool is called the cash-out refinance. And while the name sounds a little technical, the idea behind it is incredibly simple. You've been paying your mortgage, and the real estate market has been doing its thing. As a result, you've built up something called equity. Equity is the golden ticket. It's the portion of your home that you actually truly own. Think of it like this. If your home is worth $400,000 and you still owe $250,000 on your mortgage, you have $150,000 in equity. It's your wealth, locked inside the walls of your house. A cash-out refinance is the key that unlocks it. You're not just getting a new mortgage, you're getting a new, larger mortgage. You use that new loan to pay off your old one, and the difference, the extra cash, is handed directly to you tax-free. Let's make this real. Meet Mark and Sarah. They bought their first home 5 years ago for $300,000. They put down a little money and got a mortgage for $275,000. Over the past 5 years, they've been diligently making their payments, and their loan balance has dropped to $250,000. But here's the magic part. Their neighborhood has become really popular. Homes are selling fast. They get their house appraised, and it's now worth a whopping $450,000. Let's do the math. $450 in value minus $250 in debt means they are sitting on $200,000 in equity. It's fantastic, but it's just a number on paper. They can't use that $200,000 to fix their horribly outdated 1980s kitchen, which they've been dreaming of renovating since the day they moved in. They got a quote. A full gut job, new cabinets, new appliances, the works. $50,000. So what are their options? They could put it on credit cards, but with interest rates at 20-25%, that $50,000 kitchen would end up costing them close to $80,000 by the time they paid it off. Ouch. They could try to get a personal loan. Maybe they'd get a better rate, say 12%. Still, that's a hefty $6,000 a year in interest alone. Or they could tap into that massive pile of wealth they've built in their home. They decide to explore a cash-out refinance. They go to a lender, and here's how the lender sees it. The home is worth $450,000. Most lenders will let you borrow up to 80% of your home's value. This is a critical number called the loan-to-value ratio, or LTV. 80% of $450,000 is $360,000. That's the maximum loan they could possibly get. But Mark and Sarah don't need that much. They need to pay off their existing $250,000 mortgage, and they need $50,000 for the kitchen. So they apply for a new mortgage of $300,000. The loan gets approved. Closing, the magic happens. The new lender sends $250,000 directly to their old mortgage company, wiping it out completely. It's gone. Then, the lender cuts a check to Mark and Sarah for the remaining $50,000. Cash. In their bank account, they now have a single new mortgage for $300,000 and the money to build the kitchen of their dreams. Now, why is this so powerful? Because they borrowed that $50,000 not at a credit card rate of 25% or a personal loan rate of 12%. They borrowed it at their new mortgage rate. Let's say that's 6.5%. By using their home's equity, they cut their interest rate on that $50,000 in half compared to a personal loan, and by nearly 3/4 compared to a credit card. They are saving thousands upon thousands of dollars in interest, making their dream kitchen dramatically more affordable. This is what we mean by turning your house into your own personal bank. You're borrowing from yourself in a way at a much lower cost. But like any powerful financial tool, you have to understand the trade-offs. This isn't free money. First, Mark and Sarah's mortgage payment is now based on a $300,000 loan, not $250,000. Their monthly payment will be higher. They need to be sure they can comfortably afford that new higher payment. Second, they've reset their loan clock. They were 5 years into their old 30-year mortgage. Now they're at the beginning of a brand new 30-year mortgage. This means they'll be paying interest for a longer total period. And third, refinancing isn't free. There are closing costs, fees for the appraisal, title insurance, and loan origination, which can be several $1,000s. You have to weigh those costs against the benefit of the cash you're getting. For a $50,000 renovation, those costs are often well worth it. For a $5,000 vacation? Almost certainly not. The cash-out refinance is a fantastic option for a large one-time expense. But what if your financial needs are different? What if you need flexibility? What if you're not sure exactly how much money you'll need? Or when you'll need it? Maybe you're starting a business, or you have kids heading to college in a couple of years and you'll have tuition bills coming in every semester. For that, there's another equally powerful way to tap your equity, and it's called a home equity line of credit, or HELOC. If a cash-out refinance is like getting a big, one-time loan, a HELOC is like getting a credit card that's secured by your house. It works very differently. Instead of taking out a whole new mortgage, your lender simply approves you for a line of credit, a maximum amount you can borrow against, based on the equity in your home. Let's go back to Mark and Sarah. With $200,000 in equity, a lender might approve them for a HELOC of up to, say, $100,000. But here's the key. They don't get all that money at once. It just sits there available to them. Their kitchen project has a few phases. First, the demolition and new plumbing, which costs $10,000. They can write a check or use a special debit card linked to their HELOC to pay the contractor. Now they've used $10,000 of their $100,000 credit line. They only pay interest on the $10,000 they've actually used, not the full $100,000. A few months later, the cabinets are ready. That's another $20,000. They draw that amount. Now their balance is $30,000. They're paying interest on $30,000. They can draw money as they need it, and often they can pay it back and then borrow it again, just like a credit card. This flexibility is the HELOC superpower. It's perfect for ongoing projects or unpredictable expenses. Most HELOCs have two phases. First is the draw period, usually the first 10 years. During this time, you can borrow and repay money as you see fit, and you might only be required to pay the interest each month. After the draw period ends, you enter the repayment period, which might be the next 20 years. You can no longer borrow money, and you have to start paying back the principal you borrowed plus interest. But here's the big, flashing warning sign for HELOCs. The interest rate is almost always variable. This means it's tied to a benchmark rate like the prime rate, and when that rate goes up, your HELOC interest rate goes up too. In a rising interest rate environment, your monthly payments can increase, sometimes significantly. This is a huge contrast to the cash-out refinance, where you lock in a single, fixed interest rate for the life of the loan. You get stability and predictability. With a HELOC, you get flexibility, but you take on the risk of rising rates. So how do you choose? Comes down to your goal. Do you have a single, large, well-defined expense like Mark and Sarah's kitchen remodel? A cash-out refinance is often the better choice. You get all the money at once, and you lock in a fixed interest rate you can budget for permanently. Do you need an ongoing financial safety net, funding for a multi-stage project, or a way to pay for recurring costs like college tuition? The flexibility of a HELOC might be the perfect fit, as long as you understand and are comfortable with the risk of a variable interest rate. Both are incredible tools for turning the paper wealth in your home into real usable cash. They can save you a fortune compared to high-interest debt and open up possibilities that might otherwise be out of reach. Now we know the what. A rate and term refi to save money monthly, and a cash-out or HELOC to tap into your home's equity. You understand the mechanics. But that leads to the most important question of all. When is the right time to pull the trigger? It's not just about what interest rates are doing on the news. It's about your personal financial situation, your goals, and a crucial calculation that tells you the exact month and year your refinance will actually start saving you money. Getting this timing right is the difference between a smart financial move and a costly mistake. And figuring out that perfect moment, that's what we're breaking down next. So let's put ourselves at the kitchen table. In front of you is a stack of papers from a potential lender. Your eyes scan the columns of numbers, the jargon, the fine print. It's overwhelming, but two numbers jump out at you. The first is the total closing costs. Let's say it's $5,000. A hard number to swallow. But then your eyes drift to the second number, the monthly savings. Your new payment would be $250 less than your current one. That feels incredible. But that $5,000 fee is the gatekeeper. It's the price of admission to those monthly savings. The single most important question you have to ask yourself is, when do I get my $5,000 back? This is called the break-even point. It is the most critical calculation in the entire refinancing process. It's the moment in time when your accumulated monthly savings have officially paid back your upfront closing costs. From that month forward, every single dollar you save is pure, unadulterated profit in your pocket. Before that month, you're still technically in the red from the refi. The math itself is surprisingly simple. You just take your total closing costs and divide them by your monthly savings. The result is the number of months it will take to break even. Let's make this real. Imagine a family, the Jacksons. They have a 30-year mortgage for $400,000 at a 6.5% interest rate. Their monthly principal and interest payment is about $2,528. They've been seeing ads for lower rates, and they find a lender willing to refinance their remaining balance at a new rate of 5.5%. Their new monthly principal and interest payment would be $2,271. The monthly savings? $257. That's real money. That's a car payment, a serious dent in the grocery bill, or a healthy boost to a college fund every single month. But then comes the closing cost. The lender quotes them $6,000 to get the deal done. So let's do the math for the Jacksons. We take the $6,000 in closing costs and divide it by their $257 in monthly savings. The answer is 23.3. Let's round that up to 24 months. This means for the first 2 years after they refinance, the Jacksons are essentially just paying back their closing costs. They don't really see a net benefit until month 25. On that 25th month, they are officially in the green. They've broken even. From that point on, for the entire remaining life of their loan, they are pocketing an extra $257 every month. Now here is the million-dollar question that determines whether this is a brilliant move or a financial disaster for the Jacksons. How long do they plan to live in that house? If they know for a fact they'll be in that home for the next 10 years, this is a no-brainer. They have 8 years or 96 months of pure savings after their break-even point. That's over $24,000 in their pocket that they wouldn't have had otherwise. But what if they have a sneaking suspicion they might get a job transfer in 2 years? What if they're thinking about upgrading to a bigger house in 18 months? If they sell that house before hitting the 24-month break-even point, they will have lost money. They will have paid $6,000 in fees just to save a little bit of money for a short time, but not enough to even cover the cost of the transaction. They walked away poorer than if they had done nothing at all. This is the central rule of refinancing. Your break-even point must be shorter than the amount of time you plan to stay in your home. It's not about the interest rate. It's not even about the monthly savings. It's about the timeline. If you're planning on moving in 3 years, and your break-even point is 4 years, you stop right there. The deal is dead. Do not pass go, do not pay $6,000 in closing costs. So, that begs the question, what exactly are you paying for in those closing costs? Why are they so high? It's not just one single fee. It's a bundle of different charges from different parties involved in the transaction, and you need to know what they are. First up, you have the lender fees. The most common one is the origination fee. This is what the lender charges for the administrative work of processing, underwriting, and approving your loan. It's often calculated as a percentage of the total loan amount, usually somewhere between 0.5% and 1%. On a $400,000 loan, that could be $2,000 to $4,000 right there. Sometimes you'll also see smaller charges like application fees or processing fees. Next, you have third-party fees. These are costs paid to other companies that are required to get the loan done. The big one here is the appraisal fee. The new lender needs to independently verify that your home is still worth enough to be collateral for the loan they're about to give you. They hire a licensed appraiser to inspect your property and determine its current market value. This can cost anywhere from $400 to $800, sometimes more depending on your location and property type. Then there's title services. This is crucial. A title company does a deep dive into your property's history to make sure there are no outstanding liens, claims, or legal issues that could jeopardize ownership. You're paying for a title search to ensure the coast is clear, and you're also buying a new lender's title insurance policy. This policy protects the lender, not you, in case some long-lost heir or unpaid contractor comes out of the woodwork later and tries to lay claim to your property. This can easily run over $1,000. You might also have attorney fees, especially in certain states where a real estate attorney is required to oversee the closing. They're there to review documents and ensure the transaction is legally sound. And finally, you have prepaid items and escrows. These aren't technically fees, but they are cash you need to bring to the table. You might have to prepay the interest that will accrue on your new loan between your closing date and your first official payment. The lender will also need you to fund a new escrow account. They'll collect a few months' worth of property taxes and homeowners insurance up front to create a cushion in that account, ensuring those critical bills get paid on time. While you'll eventually get the money from your old escrow account refunded to you, it's still an upfront, out-of-pocket expense you have to plan for. When you add it all up, origination, appraisal, title, attorney, prepaids, you can see how quickly it balloons into thousands of dollars. It's this daunting number that stops many people in their tracks. They see the potential long-term savings, but they can't or don't want to part with that much cash right now. And lenders know this. They understand that the closing costs are the single biggest point of friction in the whole process. So, they came up with a very seductive, very powerful alternative. An offer that seems to solve this entire problem in one fell swoop. It's called the no closing cost refinance. Sounds like magic. All the benefits of a lower payment without having to write that massive check. But as we all know, there's no such thing as a free lunch, especially in the world of finance. The costs don't just vanish into thin air. They have to go somewhere. The lender is a business, not a charity. So they give you two options for how to handle these no-cost deals. Option 1 is they roll the closing costs directly into your new loan balance. So if you owe $300,000 and have $6,000 in closing costs, your new loan will be for $306,000. You're not paying cash up front, but you are now paying interest on those closing costs for the life of the loan. Option 2, and this is the more common one, is that the lender offers you a slightly higher interest rate in exchange for a credit that covers your closing costs. So instead of getting that 5.5% rate, maybe they offer you a 5.875% rate, and in return they give you a $6,000 credit at closing. You walk away with a new lower payment and zero out-of-pocket expenses. This creates a fascinating dilemma, a fork in the road. Do you pay the closing costs up front to secure the absolute lowest interest rate possible, maximizing your long-term savings? Or do you accept a slightly higher rate to avoid that immediate financial pain, keeping thousands of dollars in your pocket today? One path saves you more money over 30 years. The other path costs you nothing right now. Which one is the right move for you? And more importantly, how can you tell if a lender's no-cost offer is a genuinely good deal, or just a clever way to charge you more in the long run? That decision, that calculation is where the real money is made or lost. And that's exactly what we're breaking down next. So let's pull back the curtain on this no-cost refinance. The first rule you need to internalize is this: there is no such thing as a free mortgage. Lenders are not charities, they are businesses, and they are very, very good at making money. The closing costs, the appraisal fees, the title insurance, the underwriting fees, those are real costs that someone has to pay. If that someone isn't you writing a check at the closing table, then the cost is simply being paid for in a different, less obvious way. Think of it like a shell game. The cost is the little p, and the lender has two shells they can hide it under. Your job is to figure out which shell it's under and if that works for you. The first way a lender creates a no-cost refinance is by giving you a slightly higher interest rate. This is the most common method. Let's say the absolute best market rate you qualify for today is 6%. A lender might come to you and say, "Hey, we'll cover all $5,000 of your closing costs. You pay nothing out of pocket. All you have to do is take this 6.375% interest rate instead." What's happening behind the scenes is that the lender can sell that loan with a higher interest rate on the secondary market for a bigger premium. They get a kickback, essentially, for originating a loan that will pay more interest over time. They then use a portion of that premium, that kickback, to pay your closing costs. They call this a lender credit. It's a credit that covers your closing costs, and it's paid for by your higher interest rate. So is it no cost? Absolutely not. You are paying for it every single month for the life of the loan in the form of a higher interest payment. The second way they can do it is by rolling the closing costs into your loan balance. This is different. In this scenario, you get the absolute best interest rate you qualify for, that rock bottom 6%. The lender isn't charging you a higher rate. Instead, they take the $5,000 in closing costs and just add it to the amount you're borrowing. So if you were refinancing a $300,000 mortgage, your new loan balance wouldn't be $300,000. It would be $305,000. You didn't pay cash out of your pocket, which feels like a win, but you just borrowed more money. You've reduced your home's equity by $5,000, and you will now be paying interest on that extra $5,000 for the next 30 years. Again, is it no cost? Not even close. You've simply financed the cost instead of paying for it up front. So we have three distinct options on the table. 1. You pay the closing costs out of your own pocket and get the lowest possible interest rate on your original loan balance. 2. The lender pays the costs and you take a higher interest rate. 3. You roll the costs into the loan, keeping the low rate but increasing your total debt. This is the critical decision point, and the right answer depends entirely on one single question. How long are you going to stay in this house? This is where we do the math that saves you thousands. It's called a break-even analysis. Let's go back to our example. A $300,000 loan. Closing costs are $5,000. Option A is paying the $5,000 out of pocket to get a 6% interest rate. Your principal and interest payment on that would be about $1,798 a month. Option B is the no-cost option, where the lender covers the $5,000, but you get a 6.375% interest rate. Your principal and interest payment on that same $300,000 loan would be about $1,871 a month. Okay, so the no-cost option costs you an extra $73 every single month. To find your break-even point, you take the total cost you avoided paying upfront, that $5,000, and you divide it by the extra amount you're paying each month. So $5,000 divided by $73. That equals 68.4. Let's call it 69 months. That means it will take 69 months or 5 years and 9 months for the extra $73 you're paying each month to add up to the $5,000 you saved at closing. This is everything. If you know for a fact that you're going to sell this house or refinance again in the next 3 or 4 years, then taking the no-cost option B is a brilliant move. You'll save $5,000 in cash today, and you'll sell the house long before you ever hit that break-even point. You will have come out ahead. But if this is your forever home, or you plan on being there for 10, 15, 20 years, taking that no-cost option would be a monumental mistake. After that 69-month mark, every single month for the rest of the loan, you are lighting $73 on fire. Over the life of that loan, that free refinance will cost you tens of thousands of dollars in extra interest. In that case, you absolutely want to scrape together the $5,000 to pay the closing costs and secure that lower 6% rate. Now what about the third option, rolling the costs into the loan? Let's analyze that. You get the low 6% interest rate, but your loan balance is now $305,000. Your monthly payment on that would be $1,828. So, compared to paying the costs out of pocket, this option costs you an extra $30 a month. But unlike the higher rate option, there's no break-even point where you suddenly start winning. You are simply paying more every single month because you borrowed more. And you've lost $5,000 in equity. So why would anyone do this? The answer is usually cash flow. Maybe you don't have $5,000 in savings to pay closing costs. Rolling them into the loan is a way to get the refinance done without needing cash on hand. It's a better long-term option than taking the higher interest rate if you plan to stay in the home for a long time, because that extra $30 a month is far less painful than the extra $73 a month from the higher rate. You're still getting the best underlying interest rate, which is the most powerful factor in a mortgage over the long run. So let's put this into a simple framework. If you plan to be in the house for a short time, less than your break-even point, the no-cost refinance with the higher interest rate is often the smartest financial move. You get the benefit without the long-term pain. If you plan to be in the house for a long time, paying the closing costs out of pocket to get the lowest possible rate is almost always the champion. It will save you the most money by a huge margin. And if you plan to be in the house for a long time but you are short on cash, rolling the costs into the loan is your best alternative. It's a compromise. You take a small hit on your monthly payment and equity, but you still secure that fantastic long-term interest rate that will save you money over the decades. Understanding this trade-off between upfront costs and the interest rate is the most important concept in refinancing. Don't let a lender's marketing about no cost make the decision for you. You are the one who needs to run the numbers based on your own life plans. Ask the lender for quotes showing all three scenarios: paying points and fees yourself, a zero-cost option with a lender credit, and an option with the costs rolled into the principal. They have to provide you with this information on a document called a loan estimate. Compare them side by side and calculate your own break-even point. This is how you take control of the process. This is how you turn their shell game into a calculated decision that serves your financial goals, not theirs. Now that you know exactly how the costs of a refinance are paid, we can get into the really interesting part, the different types of refinance loans. Because refinancing isn't just about getting a lower rate. What if you could use it to pull out tens of thousands, or even hundreds of thousands of dollars in cash tax-free, to pay off credit card debt, student loans, or finally build that dream kitchen? That's called a cash-out refinance. It is an incredibly powerful financial tool, but it also comes with some serious equity-destroying risks you absolutely need to understand before you even think about it. And we're going to uncover exactly what those are next. So let's pull back the curtain on this tempting financial product. A cash-out refinance at its core is when you replace your current mortgage with a new, larger mortgage, and you get to pocket the difference in cash. Imagine your home is a piggy bank that you've been filling for years with your mortgage payments. A normal refinance is like swapping that piggy bank for a new one with a better interest rate lock. A cash-out refinance is like taking a hammer to the piggy bank, scooping out a handful of cash for yourself, and then putting the rest of the money into that new loan. The allure is undeniable. Suddenly, the wealth trapped in your walls becomes liquid. It becomes spendable. People use this cash for all sorts of things. The most common reason is home renovations. You take out $50,000 to finally build that dream kitchen or finish the basement. Another huge one is debt consolidation. You have $20,000 in high-interest credit card debt, so you pull that money from your home equity and pay it all off with a single lower-interest loan. Other people use it to pay for college tuition, start a business, cover major medical expenses, or even just build a significant emergency fund. It feels like you're unlocking your own money, feels smart, feels powerful, and in some very specific circumstances which we will cover, it can be. But this is where the danger lies. The marketing makes it sound like free money, a simple trick to access your own wealth. It is anything but. To understand the risks, let's use some simple round numbers. Let's say your home is currently worth $500,000. And let's say you have an outstanding mortgage balance of $200,000. This means you have $300,000 in home equity. That's the portion of the home you truly own. Now, you decide you want $50,000 in cash for a home improvement project. You go to a lender for a cash-out refinance. They'll approve a new mortgage for $250,000. That new loan first pays off your old $200,000 mortgage completely. The remaining $50,000, minus a few thousand in closing costs, is wired directly to your bank account. Congratulations! You have the cash. But what just happened to your financial position? You went from owing $200,000 on your home to owing $250,000. Your equity, your actual wealth, just dropped from $300,000 down to $250,000. You essentially just sold a piece of your home back to the bank. And that single transaction sets off a chain reaction of 4 hidden risks that can cost you tens, or even hundreds, of thousands of dollars over the long term. The first and most overlooked risk is what I call the time machine trap. You are resetting your mortgage clock. Let's say you were 10 years into your original 30-year mortgage. You had 20 years left. You were past the toughest part of the amortization schedule, where most of your payment goes to interest. You were finally starting to make real headway, with more of each payment going toward your principal balance, building your equity faster. By refinancing into a new 30-year loan, you've just teleported yourself all the way back to day one. You're back in the interest-heavy zone. That 20-year finish line you were heading towards is now a 30-year marathon. In total, you'll have been paying a mortgage on that house for 40 years. The amount of extra interest you'll pay because of that 10-year extension can be absolutely staggering. This leads directly to the second risk, the raw cost of the new debt. People get fixated on the interest rate. They think, well, I'm paying off my 25% interest credit cards with a 6% mortgage. I'm a genius. And on the surface, that logic holds up. But you're not borrowing that money for 2 or 3 years like a personal loan. You're borrowing it for 30 years. Let's go back to our $50,000 example. At a 6% interest rate over 30 years, that $50,000 you borrowed will cost you an additional $57,919 in interest alone. That's right. The $50,000 kitchen actually cost you over $107,000. You paid more in interest than you did for the thing itself. The bank is more than happy to give you a lower rate, because they know they'll be collecting it from you for the next 3 decades. The third, and perhaps most dangerous risk, is the destruction of your safety net. Your home equity is more than just a number on a piece of paper. It's your financial cushion. It's what protects you if the housing market takes a downturn. If you have $300,000 in equity and the market drops 10%, your home value falls by $50,000, but you're still in a great position with $250,000 in equity. But what if you'd already done the cash-out refi? You started with only $250,000 in equity. The same market drop erases $50,000 of it, leaving you with just $200,000. Another small dip, and you could suddenly be underwater, owing more on your mortgage than your house is even worth. This traps you. You can't sell without bringing a massive check to the closing table. You can't refinance. You are completely at the mercy of the market, all because you treated your home like an ATM and withdrew your safety cushion. And finally, there's the fourth risk, the great debt switcheroo. This is for everyone thinking about using a cash-out refi for debt consolidation. You're taking unsecured debt, like credit cards and personal loans, and transforming it into secured debt. What does that mean? It means you are securing the debt with your house. If you lose your job and can't pay your Visa bill, they can send you to collections, they can sue you, they can ruin your credit score. But they cannot come and take your house. It's unsecured. However, when you roll that debt into your mortgage, you've now tied it to your property deed. If you lose your job and can't make your new, larger mortgage payment, the bank doesn't just sue you. They foreclose. They take your home. You are literally gambling the roof over your head to pay off a credit card. It is an enormous, often unnecessary risk that transfers all the power from you to the lender. So when you add it all up, resetting the 30-year clock, paying massive long-term interest, stripping your protective equity, and securing previously unsecured debt, the cash-out refinance reveals itself to be a financial tool with some incredibly sharp edges. It promises a quick and easy solution, but it can create long-term problems that are far worse than what you started with. But does this mean it's always a bad idea? Is there ever a situation where taking cash out of your home is the smartest possible move? The answer, surprisingly, is yes. There are specific scenarios where a cash-out refinance, when used strategically and with full awareness of these risks, can actually accelerate your wealth. And that's exactly what we need to break down next. Let's start with a fundamental concept that separates the wealthy from everyone else: leverage. Leverage is simply using borrowed money to increase the potential return of an investment. And your home, well, the equity in your home is one of the most powerful and accessible forms of leverage you will ever have. Think of it like a crowbar. You could try to lift a massive boulder with your bare hands and get nowhere. But with a crowbar, with leverage, you can move it. A cash-out refinance is how you get your hands on that crowbar. It allows you to transform the dormant passive equity sitting inside the walls of your house into active capital that you can put to work. But just like a crowbar can be used to build something or to smash your own foot, this capital can either build your wealth or destroy it. The difference comes down to one simple, non-negotiable rule. If you remember nothing else from this video, remember this. The golden rule of cash-out refinancing is to only use the money to purchase or invest in an asset that has a high probability of generating a return greater than the interest rate of your new mortgage. Let me say that again. The asset you buy must make you more money than the loan is costing you. You are, in essence, borrowing money at one rate, say 6%, to make money at a higher rate, say 10%. That 4% difference? That's called the spread, and that is how you get rich. Let's break this down with real-world scenarios. The most classic and time-tested strategy is using a cash-out refinance to buy more real estate. Let's imagine a couple, we'll call them Mark and Jessica. They bought their home a few years ago for $400,000. Today, it's worth $600,000, and they've paid their mortgage down to $300,000. They have $300,000 in home equity. Now they could just sit on that equity, and that's fine. It's safe. But Mark and Jessica are ambitious. They see an opportunity. A small duplex in a growing part of town is for sale for $250,000. They've done their research. They know it can generate rental income. But they don't have the $50,000 they need for a 20% down payment sitting in their savings account. So they go to their lender. They do a cash-out refinance. They take out a new mortgage for $360,000. This pays off their old $300,000 loan and gives them a check for $60,000 in cash. We'll say their new interest rate is 6.5%. Yes, their monthly mortgage payment on their primary home just went up. This is a critical point. Their monthly expenses have increased. But what did they do with that $60,000? They took $50,000 and used it as a down payment on that duplex. They used another $5,000 for closing costs. The remaining $5,000 they kept as a reserve fund for repairs. Now they own two properties, their primary home and a duplex that they now rent out. Let's say after the mortgage, taxes, insurance, and a budget for maintenance on that new duplex, their total monthly cost for it is $1,600. But the rent they collect from the two units is $2,200 per month. That's a positive cash flow of $600 every single month. That's $7,200 a year in pure profit. Now let's go back to the golden rule. They borrowed that money at 6.5%. Is their new asset, the duplex, generating a return greater than 6.5%? Well, let's calculate their cash-on-cash return. They invested $55,000 of the borrowed money to get an annual return of $7,200. That is a 13% return on their investment. Since 13% is much greater than the 6.5% they're paying on the loan, this was a brilliant financial move. They used the debt equity in their home to buy an entirely new asset that not only pays for itself but also puts money in their pocket every month. On top of that, their tenants are now paying down the mortgage on the duplex, building more equity for Mark and Jessica, and the property itself is likely to appreciate over time. They literally turned the value of one house into two, dramatically accelerating their path to financial freedom. Okay, so real estate is the classic example. But what if you're not interested in being a landlord? Let's turn up the risk dial a bit and talk about investing in the stock market. This strategy is more controversial, but it's one that sophisticated investors use all the time. Let's go back to Mark and Jessica. Instead of buying the duplex, they take that same $60,000 from their cash-out refi and decide to invest it in a low-cost, broad market index fund like one that tracks the S&P 500. Their loan still costs them 6.5% per year. The historical average annual return of the S&P 500, over long periods, is around 10%. According to the golden rule, this works. They are borrowing at 6.5% to invest for a potential return of 10%. That 3.5% spread is their profit, supercharged by the power of compound interest over years and decades. That initial $60,000 could grow to hundreds of thousands of dollars by the time they retire. Now I have to give a massive warning here. This is not for everyone. The stock market is not a rental property that provides steady monthly cash flow. It's volatile. While the average return is 10%, in any given year it could go up 25% or it could crash by 30%. If the market has a terrible year and their investment drops to $40,000, guess what? They still owe the full $60,000 plus 6.5% interest. And their home is the collateral. This strategy requires a very high risk tolerance, a long time horizon to ride out the market downturns, and the discipline not to panic sell at the bottom. It's playing with fire, but if managed correctly over decades, it can pour gasoline on your wealth-building engine. Let's look at one more powerful scenario. Investing in yourself by starting a business. Maybe Jessica is an incredible baker and has always dreamed of opening her own specialty cake shop. She has a rock-solid business plan, a loyal following from selling cakes out of her home, But she needs $50,000 for a commercial kitchen lease, equipment, and initial marketing. A traditional small business loan is hard to get and often comes with incredibly high interest rates. But a cash-out refinance? It gives her access to that capital at that same, relatively low 6.5% mortgage rate. This is betting on yourself, and it's arguably the highest risk, highest reward scenario of all. If the business fails, the $50,000 is gone, and that debt is now permanently attached to their home. It's a devastating blow. But if the business succeeds, a successful business can generate returns of 20%, 50%, or even 100% or more per year, absolutely dwarfing the 6.5% cost of the loan. It could change their family's financial future in a way that nothing else could. Do you see the common thread here? Real estate, stocks, a small business, these are all assets. They are things that are designed to grow in value or produce an income. This is the fundamental mindset shift. When you do a cash-out refinance for investment, you're not just taking on more debt. You are executing an arbitrage play. You are acquiring capital at a wholesale price, your mortgage rate, and deploying it into an asset that provides a retail return. You're using your home's equity as a launchpad, not a piggy bank. This is how you stop trading your time for money and start having your money make money for you. We've seen the power of using a cash-out refinance as a launchpad for wealth. But with great power comes great responsibility and the potential for financial disaster. The line between a brilliant financial move and a catastrophic mistake is razor thin. So what are the absolute worst ways to use a cash-out refinance? The traps that look tempting but can lead straight to foreclosure? That's what we have to uncover next. The first and most seductive trap is using your home equity to fund a lifestyle you can't actually afford. It's the siren song of easy money, whispering that you deserve that luxury European vacation, that brand new $60,000 SUV, that complete designer wardrobe. So you pull out $50,000, maybe $75,000. The cash hits your account, and it feels like you've won the lottery. You book the flights, you drive the car off the lot, and for a few weeks life is incredible. But the high is temporary. The debt is permanent. You've just taken a short-term desire and bolted it onto a 30-year loan, secured by the most important asset you own. That vacation becomes a distant memory, but the extra $400 on your mortgage payment shows up month after month, year after year. That shiny new car loses 20% of its value the second you drive it off the lot, yet you'll be paying for its ghost with interest for decades. You haven't created wealth. You've performed a financial magic trick on yourself, turning solid, valuable home equity into thin air and a heavier chain of debt. It's like using the foundation of your house to buy patio furniture. It looks nice for a season, but you've fundamentally weakened the entire structure. When a real financial storm hits, a job loss, a medical emergency, you'll look to your home for shelter, only to find you've already sold off the bricks and mortar for a fleeting good time. The second trap is even faster and potentially more devastating. Using your home as a personal casino. This is the allure of the high-risk, get-rich-quick investment. You hear stories about people making a fortune in crypto, or a friend gives you a can't-miss tip on a speculative stock. The temptation is immense. You think, I'll just cash out $50,000, put it in this investment, double my money in 6 months, and pay the loan back immediately. Easy. But you are fundamentally misunderstanding the nature of risk. You are taking guaranteed low-interest debt, the safest form of leverage a normal person can get, and pouring it into one of the riskiest, most volatile assets on the planet. This isn't investing. It's gambling with the roof over your family's head. When you invest with your savings, the worst-case scenario is you lose your savings. It's painful, but you still have your home. When you invest with your home equity, the worst-case scenario isn't just losing the money. You lose the money, and you still owe the bank the full $50,000 plus interest for the next 30 years. Your mortgage payment is now permanently higher. Your net worth has plummeted, and you have absolutely nothing to show for it. You've traded a tangible piece of your financial security for a losing lottery ticket. Banks lend you money against your house because it's a stable, secure asset. The moment you convert that security into a wild gamble, you've broken the fundamental principle of sound financial management. But the third trap, this one is the most insidious. It's the most common, and it's the one that feels the most responsible on the surface. It's the trap of consolidating debt without changing your behavior. Here's how it plays out. You've racked up $30,000 in high-interest credit card debt. The 24% APR is crushing you. You're making minimum payments and getting nowhere. So you do a cash-out refinance. You pull $30,000 out of your home, pay off every single credit card in one fell swoop. The relief is euphoric. Feels like a massive weight has been lifted. Your multiple high-interest payments are gone, replaced by one slightly larger, manageable mortgage payment. You feel like you've conquered your debt. But you haven't. You haven't conquered anything. All you've done is move the debt from one bucket to another. You haven't addressed the root cause of the debt, the spending habits, the lack of a budget, the lifestyle that led to $30,000 on credit cards in the first place. And this is where the trap snaps shut. You look at your wallet full of zero-balance credit cards, and your brain doesn't see danger. Sees opportunity. It sees available credit. Few months go by. The car needs new brakes. I'll just put it on the card and pay it off next month, you say. Then a sale on a new TV is too good to pass up. Then the holidays roll around. Slowly, insidiously, the balances start to creep back up. You're not paying 24% interest anymore, so it doesn't feel as urgent. But within 2 or 3 years, you're right back where you started, staring at $25,000 or $30,000 in credit card debt. Except now, the situation is catastrophic. Because you also still have the original $30,000 you refinanced, which is now locked into your mortgage. You didn't eliminate your debt. You doubled it. You've converted unsecured debt that, in a worst-case bankruptcy scenario, could be wiped away, into secured debt that is welded to your home. If you default now, they don't just send you to collections, they take your house. This is the ultimate financial quicksand. By trying to solve one problem, you've created a second, far more dangerous one, and tethered both of them directly to your family's home. Finally, there's the subtle but foolish mistake of using a cash-out refinance as your primary emergency fund. The thinking goes, I have $100,000 in equity. If my furnace breaks or I lose my job, I'll just tap into it. This is a terrible plan for 2 reasons. First, speed. A refinance is not a quick process. It takes 30, 45, even 60 days from application to closing. A true emergency like a medical crisis or a sudden job loss happens now. It can't wait 2 months for you to navigate appraisals and underwriting. By the time you get the cash, the damage may already be done. Second, cost and commitment. You're paying thousands in closing costs and re-amortizing your entire mortgage just to have cash on standby. If you pull out $40,000 for an emergency fund and let it sit in a savings account, you are paying mortgage interest on that $40,000 every single month for no reason. It is one of 100 better tools for this job. A high-yield savings account is liquid and costs nothing. A home equity line of credit, or HELOC, is designed for this exact purpose. It gives you a line of credit you can draw on instantly when needed, and you only pay interest on what you use. Using a full cash-out refinance as your emergency plan is like using a sledgehammer to hang a picture frame. It's the wrong tool, it's clumsy, it's expensive, and it's likely to cause far more damage than it solves. Each of these traps stems from the same core misunderstanding. Viewing your home equity as a windfall, like a bonus check or a lottery win. It is not. It is the bedrock of your financial life. It is your family's stability, your forced savings account, and your ultimate safety net. Using it for anything other than a strategic, calculated investment in your future, one that provides a clear and probable return, is setting a fire to your own parachute just to feel a moment of warmth. Now that we've walked through this minefield, and we understand the traps that can lead to financial ruin, a critical question emerges. These are the wrong ways, what are the right ways? How do the wealthy and financially savvy use a cash-out refinance not as a tool for consumption, but as a powerful engine for building real generational wealth? What are the strategic moves that turn your home's equity into an asset that works for you, instead of a debt that weighs you down? That's exactly where we're going next. Let's start with a fundamental shift in perspective. Most people see their home equity as a safety net, an emergency fund locked behind glass that you only break in case of a dire crisis. But the wealthiest individuals, the savviest investors, they see it completely differently. They don't see a safety net. They see a launch pad. They see a reservoir of low-cost capital that can be strategically deployed to acquire more assets. This is the single biggest mindset shift you can make. Your home isn't just a place to live. It's the cornerstone of your personal balance sheet. And a cash-out refinance is the tool you use to put that balance sheet to work. Let's get concrete. The most powerful strategy, one that has created countless real estate millionaires, is known as the BRRR method. That's BRRR. It stands for buy, rehab, rent, refinance, repeat. And the second R, refinance, is the linchpin that makes the entire system a perpetual motion machine for wealth. Here's how it works in the real world. Imagine you find a distressed property, a diamond in the rough, for $200,000. It needs work, but you've done your homework. You use a combination of savings and maybe a hard money loan to purchase it. You then invest $50,000 into renovating it: new kitchen, updated bathrooms, fresh paint, curb appeal. Your total cash investment into this project is now $250,000. After the renovation, the property is beautiful. You get it professionally appraised, and because of the improvements and the smart purchase you made, it now appraises for $400,000. This is what's called forced appreciation. You didn't just wait for the market to go up. You actively increased the property's value. Now you have a tenant in there, paying you rent every month, which covers the property's expenses and then some. This is where the magic happens. You go to a lender and say, "I want to do a cash-out refinance on this investment property." The bank looks at the new shiny appraisal of $400,000. They'll typically lend you up to 75% or 80% of that appraised value for an investment property. Let's use 75% for a conservative example. 75% of $400,000 is $300,000. The bank gives you a new loan for $300,000. With that money, you first pay off any original loan you had to buy the place. But remember, your total cash into the deal was only $250,000. So you receive a check from the bank for $300,000. You pay back your initial $250,000 investment, and you are left with $50,000 in your pocket tax-free because it's loan proceeds, not income. Let's just pause and absorb what just happened. You now own a cash-flowing rental property that is paying for its own new mortgage. You have pulled every single dollar of your original investment back out, and you were even paid $50,000 for your efforts. You have zero of your own money left in the deal, yet you own the asset. This is what investors call an infinite return. And now, with your original $250,000 plus the extra $50,000 back in your bank account, what do? You repeat. You go find the next property and do it all over again. This is how portfolios are built. It's how one property turns into 2, then 4, then 8, using the same pot of money over and over again, all powered by the strategic use of refinancing. But real estate isn't the only play. Think about the entrepreneur. You have a brilliant idea for a business. You've written the business plan, you know your market, but you need $75,000 in startup capital. What are your options? You could try to get a small business loan, which often comes with grueling application processes, high interest rates, and a high rejection rate. You could try to find investors, but that means giving up equity and control of your own company before you've even started. Or you could look at your home. Let's say you have $200,000 in equity. You could do a cash-out refinance, pull out that $75,000, and get an interest rate that is drastically lower than any business loan you'd ever qualify for. You are, in effect, becoming your own investor. You're betting on yourself, using your most valuable asset to fund your dream. Now, this is not without risk. The stakes are incredibly high. If the business fails, you don't just lose the business. You've increased the debt on your family's home. It's the definition of betting the house. But for entrepreneurs who are calculated, confident, and have a solid plan, it can be the single most effective way to access affordable capital and launch a venture without giving up ownership. A third strategic use is investing in human capital, specifically higher education. Let's say your child is heading to college, and you're staring down the barrel of Parent Plus loans. As of right now, the interest rate on those federal loans is well over 8%. It's a staggering amount of debt to take on. But what if your mortgage rate is in the SIXS or even the 7s? A cash-out refinance to pay for tuition could potentially save you tens of thousands of dollars in interest over the life of the loan. You're effectively swapping a very high-interest, non-deductible debt for a lower-interest debt where the interest is potentially tax-deductible. The unifying principle behind all these strategies is the concept of arbitrage. It's a fancy word for a simple idea: borrowing money at a low cost and investing it in something that is expected to generate a higher return. In the BRRR example, you're borrowing at a mortgage rate of, say, 7%, but the rental property is giving you a cash-on-cash return that's much higher, let's say 12 or 15%, not to mention the appreciation of the asset itself. You're making money on the spread. In the business example, you're borrowing at 7%, believing your business can generate a return on investment of 20, 30, or even 100%. You're funding massive potential growth with relatively cheap debt. In the education example, you're borrowing at 7% to avoid a loan at over 8%. while also investing in a degree that could increase your child's lifetime earning potential by hundreds of thousands or even millions of dollars. The return on that investment dwarfs the cost of the capital. This is the key. You are not just spending the money, you are deploying it as capital. You are moving it from a low-yield asset, trapped equity in your home, to a high-yield asset, a rental property, a business, or an education. However, this conversation absolutely must come with a massive flashing warning sign. This is a professional-level financial tool, not a toy. Leverage is a double-edged sword. It amplifies your gains, but it also amplifies your losses. If you use a cash-out refinance to buy a rental property and then can't find a tenant for 6 months, you are now paying 2 mortgages out of your own pocket. If you fund a business that fails, you have nothing to show for it but a larger mortgage payment every single month for the next 30 years. This strategy is not for the undisciplined. It requires rigorous analysis, conservative estimates, and a significant cash buffer for when things go wrong, because things will go wrong. It's about taking calculated risks, not gambling. The moment you start thinking of your home equity as a slush fund for a luxury vacation or a fancy car, you've lost the plot. That's a surefire way to turn your greatest asset into your greatest liability. But if you understand the risks, if you do the math, and if you adopt the mindset of an investor rather than a consumer, a cash-out refinance can be one of the most powerful wealth-building tools at your disposal. It can be the catalyst that takes you from simply owning a home to building an empire. So now you understand the high-level strategies. You're fired up, you see the potential, and you're thinking, okay, this could be for me. But what actually happens when you decide to move forward? What's the very first step? What documents do you need to start gathering tonight so you're prepared? What does that first conversation with a mortgage lender actually sound like? And what are the magic words to say to ensure you're taken seriously and get the best possible terms? The path from idea to execution is paved with paperwork and process, and knowing how to navigate it can be the difference between success and a month-long headache. And that's precisely what we're breaking down next. All right, let's map out this journey. Think of the refinancing process not as a single event, but as a series of strategic moves, like a well-played game of chess. Each step you take sets up the next, and getting them right is what leads to checkmate. A lower payment, a shorter term, or cash in your pocket. The very first move, before you even speak to a single lender, is an honest self-audit. This is where you look in the mirror and see yourself the way a lender will. There are 3 critical numbers that will define your entire refinancing experience: your credit score, your debt-to-income ratio, and your home's equity. First, your credit score. This is the gatekeeper. It's the first thing a lender looks at to decide if you're a good risk. A higher score doesn't just get you approved, it unlocks the best interest rates. We're talking about the difference between a good rate and a great one, which can save you tens of thousands of dollars over the life of the loan. Generally, you'll want a score of at least 620 to even qualify for most conventional refis, but the magic really starts to happen above 740. That's the top tier, where lenders roll out the red carpet. Before you do anything else, pull your credit report. You can do this for free from the major bureaus once a year. Look for errors and dispute them. See if you can pay down a high-balance credit card to quickly bump your score by a few points. Every point matters. Next up is your debt-to-income ratio, or DTI. This is the financial world's way of asking, can you actually afford this? It's simple math. They add up all your monthly debt payments, car loans, student loans, credit cards, plus your proposed new mortgage payment, and divide it by your gross monthly income. The result is your DTI percentage. Lenders want to see this number as low as possible. A DTI below 36% is fantastic. From 37% to 43% is generally acceptable. Once you start creeping towards 50%, lenders get very nervous. If your DTI is high, the game plan is clear. Either reduce your debt or increase your income before you apply. Finally, there's equity. We've talked about this, but it's the foundation of the whole deal. It's the portion of your home you actually own. Lenders typically want you to have at least 20% equity to refinance without having to pay for private mortgage insurance, or PMI. To figure this out, get a rough estimate of your home's current market value and subtract what you still owe on your mortgage. The result is your equity. Divide that equity by your home's value, and you have your equity percentage. If you have less than 20%, you might still be able to refinance, especially with government-backed programs, but aiming for that 20% target will give you the most options and the best terms. Once your self-audit is complete and you know your numbers, it's time to start the treasure hunt for your documents. Underwriters are meticulous. They need to verify everything. Getting your paperwork in order before you apply will make the process infinitely smoother. Think of it as building your case file. You'll need proof of income, your last 2 years of W-2s, your most recent pay stubs covering a 30-day period, and maybe your last 2 federal tax returns, especially if you're self-employed. You'll need proof of assets, the last 2 months of statements for all your bank accounts, retirement accounts, and investment accounts. And you'll need a handle on your debts, your current mortgage statement, and information on any other loans. Gather all of this into a single digital folder. When a lender asks for it, you'll be ready to send it over in minutes, looking like the most organized and reliable borrower they've seen all day. Now for the main event, shopping for a lender. This is where you can save the most money, and it's the step most people rush. Do not just go to your current mortgage provider. Their loyalty is to their bottom line, not necessarily to you. You need to comparison shop with at least 3 to 5 different lenders. Cast a wide net. Look at big national banks, local credit unions, and online lenders. And seriously consider using a mortgage broker. A broker works with dozens of wholesale lenders and can often find niche products or better rates than you could find on your own. Their job is to shop for you. When you apply, each lender is required by law to give you a standardized form called a loan estimate within 3 business days. This document is your ultimate comparison tool. It breaks down the interest rate, the monthly payment, the closing costs, and the annual percentage rate or APR. Now pay close attention here. The interest rate is not the same as the APR. The interest rate is just the cost of borrowing the money. The APR includes the interest rate plus most of the lender fees and closing costs, giving you a more accurate, apples-to-apples comparison of the true cost of each loan. When you're comparing offers, compare the APRs. Also, scrutinize Section A on the loan estimate, the origination charges. This is where lenders make their money. See how those fees vary between lenders. A slightly higher interest rate with 0 origination fees might be a better deal than the lowest rate that comes with thousands of dollars in charges. Once you've chosen a lender and a loan product, it's time to commit. You'll need to lock in your interest rate. A rate lock is a guarantee from the lender that they will honor a specific interest rate for a set period, usually 30 to 60 days, while your loan is processed. In a market where rates are fluctuating daily, this is your shield. It protects you from a sudden rate spike that could change your payment and ruin your break-even calculation. Ask your lender about their rate lock policy. Is there a fee? What happens if the processing takes longer than the lock period? Get these answers in writing. With your rate locked, your application moves into the final gauntlet. Underwriting. This is the part that feels like a black box. Your file is handed over to an underwriter whose sole job is to verify every single piece of information you've provided and make the final decision. They'll recheck your credit, verify your employment, and scrutinize your bank statements. They may come back with questions or requests for more documentation, like a letter explaining a large, unusual deposit. Respond quickly and thoroughly. This is the final checkpoint before approval. At the same time, the lender will order a home appraisal. They need an independent, professional opinion of your home's value to ensure they aren't lending you more money than the property is worth. An appraiser will visit your home, inspect its condition, and compare it to recently sold properties in your neighborhood. This is a moment of truth. If the appraisal comes in at or above the value you need, you're golden. If it comes in low, it can jeopardize the loan. You might have to bring cash to the table to make up the difference in equity, or try to renegotiate the loan amount. Finally, after surviving underwriting and the appraisal, you reach the finish line, closing. You'll receive a document called the closing disclosure at least 3 business days before your scheduled closing. This is your final report card. Your job is to compare it line by line with the loan estimate you received at the beginning. The numbers should be very close. If anything has changed significantly, especially the fees, demand an explanation immediately. At the closing itself, you'll sign a mountain of paperwork. It's tedious, but you're making a massive financial commitment, so take your time. And here's a crucial piece of protection. For a refinance on a primary residence, federal law gives you a 3-day right of rescission. This means that after you sign everything, you have 3 business days to change your mind and cancel the entire deal with no penalty. It's your final safety net. Once those 3 days pass, the deal is done. Your old mortgage is paid off, your new one takes its place, and you've successfully navigated the entire refinancing process. But crossing that finish line isn't the end of the story. In many ways, it's a new beginning. And what you do next, how you manage this new financial tool you've just acquired, is just as important as the process you just went through. The biggest mistakes, the ones that can completely negate all the savings you just fought so hard for, often happen after the papers are signed. And we need to make sure you're prepared to avoid them. The first mistake is what I call the found money fallacy. It's the most common and the most dangerous trap of them all. You've just successfully lowered your monthly mortgage payment by, let's say, $300. Your brain, after weeks of stress and paperwork, immediately translates this into, great, I have an extra $300 a month to spend. This feels like a raise, feels like a bonus, feels like you just found free money. But it is not free money. It is a mirage. Treating this monthly savings as disposable income is the single fastest way to completely undo the benefit of refinancing. You didn't go through all that effort just to finance a more expensive cell phone plan, a daily premium coffee habit, or another streaming subscription you don't need. You did it to build wealth and financial security. That $300 isn't fun money. It's freedom money. It's the key to unlocking your financial future, but only if you use it correctly. If you simply let that money get absorbed into your lifestyle, a phenomenon known as lifestyle inflation, then in 6 months you'll feel just as financially stretched as you did before, except now you've likely extended the life of your loan. You've traded long-term wealth for short-term comfort. The second major mistake is what I call post-closing amnesia. The moment the final papers are signed, a wave of relief washes over you. And it's so powerful that it can wipe your memory clean of the crucial details of your new loan. You're so happy it's over, you just want to forget about it. But the new loan is not the same as the old one. It's a completely new contract with a new account number, a new payment due date, and often a new loan servicing company. I've heard horror stories of people who meticulously managed their finances to get a great refi deal, only to get a 30-day late payment reported on their credit report the very first month. Why? Because their old automatic payment was still trying to pay the old loan, and they forgot to set up the new autopay with the new servicer. That one tiny oversight can drop your credit score by 100 points, the very score you worked so hard to perfect. You must be hyper-vigilant that first month. Know your new servicer, your new due date, and triple-check that your first payment is scheduled and processed correctly. Don't let a simple administrative error sabotage your success. The third, and perhaps most insidious mistake, is specific to those who did a cash-out refinance. It's called the debt reload. You've just done something incredibly smart. You've taken expensive, high-interest debt from credit cards, say $20,000 at 22% interest, and consolidated it into your new mortgage at a much lower rate, maybe 6 or 7%. The relief is immense. Your credit card balances are now zero. You've slain the high-interest dragon. But here's the trap. You haven't changed the habits that created that debt in the first place. You've simply emptied the bucket, and now you're standing there with a bunch of empty credit cards and the same old spending habits. The temptation to start filling that bucket back up is enormous. A small purchase here and I deserve it, splurge there. Before you know it, in a year or two, you're right back where you started with another $20,000 in high-interest credit card debt. Except now it's worse, because you've already used your home's equity to bail yourself out once. You've reloaded the debt, but this time you've done it on top of a larger mortgage. This is how people get trapped in a cycle of debt, turning their home from an asset into a permanent liability. So, how do you avoid these traps? How do you make sure your refinance is a launchpad to wealth, not a trapdoor to more debt? You create a proactive, non-negotiable plan before the new loan even closes. First, to combat the found money fallacy, you must give every single dollar of your savings a specific job before it even hits your bank account. The moment you know your new lower payment, you calculate the difference. If you save $300, you immediately go into your bank's portal and set up an automatic transfer for $300 to happen the day after your mortgage is paid. Where does it go? You decide. Maybe $100 goes directly back toward the principal of your new mortgage, effectively turning your 30-year loan into a 22-year loan. Maybe the other $200 goes into a high-yield savings account for your emergency fund, or into a retirement investment account like a Roth IRA. The key is to automate it. Make the savings invisible. You never see it, you never touch it, and you never get tempted to spend it. Your lifestyle doesn't change, but your net worth skyrockets. Second, to fight post-closing amnesia, you create a loan Bible. It can be a simple one-page document, digital or physical. On this page, you write down the new lender's name, the loan servicer's name and website, your new loan number, the exact payment amount, and the monthly due date. You take a screenshot of your first successful payment confirmation, You put this document somewhere safe and accessible. This isn't just about avoiding a late fee. It's about taking ownership. It's a declaration that you are the CEO of your debt, and you are in control. Finally, to prevent the debt reload, you must perform a financial reset. If you did a cash-out refi to pay off credit cards, you can't just go back to business as usual. You need to fundamentally change your relationship with that debt. This means creating a realistic budget that you can actually stick to. For some, it might mean literally cutting up the credit cards you just paid off. For others, it might mean putting them in a lockbox or a block of ice in the freezer, reserved only for true dire emergencies, not for a weekend sale. You have to treat those zero balances as a sacred victory, not as a new starting line for more spending. You've been given a clean slate. The goal is to keep it clean. We've covered a tremendous amount of ground together. We started by asking a simple question: what is mortgage refinancing? And we discovered it's not just about getting a lower interest rate. It's a powerful financial tool that can be used to lower your monthly payments, shorten the life of your loan, tap into your home's equity for smart investments, or consolidate high-interest debt. We walked through the entire process, from deciding if you should refinance, to preparing your finances, to navigating the application and closing. And now you know what to do after the deal is done to protect your gains and multiply your success. Refinancing isn't just a transaction you complete. It's a strategy you implement. The ultimate goal was never just to get a new loan. The goal is to use that new loan to build a better financial life, to have more options, more security, and ultimately more freedom. You now have the complete blueprint to do exactly that. The power is in your hands. Use it wisely.